Let's go across and focus on the personal finance space. Dhirendra Kumar, CEO of Value Research, with us right now. Dhirendra, thanks for joining in. There's a general view in the market that interest rates are on their way down over the calendar year. Do you also subscribe to that view?
I don't hold any view, because what has happened as a result of after the new governor, assuming his role, is that he has given a very clear roadmap. He says that his primary concern is inflation, and he is going to be guided by the consumer inflation, and that is the only thing which will drive or which will determine the interest rate. So he is not going to budge on that. He has reduced a great deal of uncertainty about the rate outlook. And from that standpoint, I think that nobody knows. I don't know when inflation will come down. I don't know. Of course, there is little ambiguity about what his comfort level of the inflation level is. What he'll be comfortable. At what level he will be prompted to consider a rate cut. But I don't think that it's going to happen in a hurry. And I don't think he is going to really change track. It is unlikely that he will change his mind. So possibly that, it's possible that by year end we will have the market cyclicality bringing down the inflation. But I don't know. I think it requires very sound economic prediction and research to really understand that what is driving our consumer inflation and what will actually bring it down.
Dhirendra, if that's the fact, or rather that is in fact the case, do you believe that now is a good time for us to invest in debt funds to profit from the interest rate cycle then?
No, I would say that most individual investors should not try to guess the interest rate. It has proved to be very less rewarding in the past. In 2012, we were guessing that the rates will come down. In 2013, everybody was thinking that, rates have been high for a long time now, and they'll come down. And for last 2 years, we have been proved wrong. So I don't think and now we have a very clear roadmap. And the critical variable which will drive the interest rate or will bring it down, it shows no symptom of coming down very sharply. So I don't think we should be guessing that. And the guessing exercise is also futile, because when you have reasonable option today, if you look at liquid fund or ultra short-term debt fund, they have yielded 9%. I think it's a very handsome return. If you are looking at corporate debt, or if you are looking at fixed maturity plans, without assuming any substantial duration risk, one is able to derive reasonable return. With great tax efficiency, the mutual fund vehicle itself gets you the tax efficiency. Over and above that, the high yield prevailing today can be derived, and you are insulated from the risk of it just in case the rate goes up. That is a possibility which can't be ruled out. So don't take your chances now, and more so, the individual fixed income investor is quite risk averse. The very reason that he is not investing in equity, he's investing in fixed income fund, is that he's risk averse, and the kind of blow that an investor gets when rates go up, and in a fairly unanticipated way, it becomes very difficult for them to reconcile with a decline in value of their fixed income investment. So that is not, this is a punt which is not worth the effort.
So which funds do you recommend at this point of time, Dhirendra?
If you are sure of your time frame, if you are investing for few weeks, consider liquid fund. If you are investing for few months, consider ultra short-term bond fund. If you are investing for less than a year, then consider a short-term bond fund, and that too a conservative one. And for longer time frame, consider FMPs. If you can map the exact time frame, today you have FMPs which can be available, which are available for a 5-year term, 3-year term, or 1.5-year term. So, and they're always on offer. Because there is a huge appetite, they are on offer most of the time. So map your investment time frame with the appropriate, the maturity date or the time frame of the fixed maturity plans, and that is all that you should be doing. And expect a decent return. Don't look at extraordinary return. Don't get tactical with your fixed income investment.